Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, we are going to talk about this theory that the crash bros have and the doomers have, that the banks are going to fail and that it'll take out housing with it.
Yes.
So that's interesting. But before we do that, that is a lovely outfit you are wearing. That looks like you did not buy that in the United States.
This is my Athens outfit. I bought it in Athens.
It looks very fancy.
And it
looks very Mediterranean. It's actually not Mediterranean. It's Adriatic.
Yes.
Because Athens is not on the Greece is not on the Mediterranean. It's on the Adriatic.
It is on the Adriatic. So just for clarification, not Athens, Georgia, which I'm sure Athens, Georgia is lovely, but that's not where I got it.
It's not that lovely.
Have you been?
Yeah, I went to grad school in the South.
Well, I know, but have you been to Athens, Georgia?
Yeah, sure. I've driven through it.
Driven through it, okay.
Yeah.
Moving on.
Didn't stop.
All right.
If you're from Athens, I apologize. It's not as I'm used to Vegas. Okay. All right. So this is what we're going to do. We're going to talk about banks. We have a lot of data from an article that just came out actually in the Wall Street Journal.
Yes.
So we're going to talk about Wall Street Journal and see if we can find something interesting. Okay. Here's the main part of the article. Bank failures then versus now. So that's the analysis we're going to do. We're going to look at what happened back then. We're going to look at what happened now. See if we can find any evidence that banks are going to just take out the fragile, extremely fragile real estate that can be taken out by literally anything. All the things that can take real estate out have failed.
I took out real estate.
Have failed, but the banks are going to do it now. All right?
Yes.
Okay, let's go back to 2008. It's 2008. Now remember, the housing crash has started. 2008, we were knee-deep into bank-owned homes. By then, you had Fannie and Freddie.
Yes.
And then I think we both had Wells Fargo.
Yeah.
And I was the second highest Wells Fargo agent in the nation for most. I had like 120 properties with Wells Fargo. And then Bank of America and a bunch of other ones. So we worked with 32 different banks and asset managers by the end of 2008. Housing had started crashing. Okay? It wasn't until 2008 that banks crashed. That was the first thing. Okay? In 2008, 25 banks failed, according to FDIC. Included in that count is WAMU, the largest bank failure in U.S. history. Over the 3 years that followed, nearly 400 banks failed. So 425 banks failed in about a 4-year period. Okay?
Yep.
All right. But remember, the housing crash had already long started.
Correct.
Okay. So really quick, before we go on to the next slide, if you saw the movie The Big Short, that will explain what happened. When you look at the comparisons between then and now, zero comparison. Okay, housing caused the liar's loans and all the crazy stuff caused the banks to crash because they're basically giving out money to people who didn't have equity.
Okay, so I want to kind of back up a little bit.
Okay.
Housing didn't cause it. It was the poor lending practices that were perpetrated on housing that caused it.
Yeah, okay. That's it. Okay, now let's flash forward to today. 3 entire banks have failed this year. Silicon Valley Bank, Signature Bank, and First Republic. That was First Republic's kind of the big one. Silicon Valley Bank, not a big bank. Only a big bank if you're a VC or a startup founder because it was all venture funds.
Right, but we need to look at what caused them to fail. It wasn't that they had poor lending practices. It wasn't that they had bad loans. It was that they mistimed the market. And what I mean by that is they chose to invest in treasuries and tie up the money long term at a very low interest rate, so they couldn't keep up with inflation and with everything else that happened. So they invested actually too conservatively, if you will.
Yeah, so we're going to talk about that specifically, but imagine this. You have a bunch of money and you need to do something with it. And so you invest it. You go put it into treasuries that pay 1% because you're like, I'm going to get 1% return. Next thing you know is you need a bunch of cash. The problem is treasuries are now paying 5%. So you have to sell your 1% treasuries.
At a huge discount because no one's going to want to buy your investment vehicle that pays 1% when they can spend their money and buy investment vehicles that pay 5% with the same risk. So what you have to do is you have to make that very enticing So let's say, for the sake of argument, that you've got $10 paying 1%. You can't sell the $10 for $10 because no one's going to want to buy that. So now you're going to sell your $10 for maybe, $5 or $6 in order to be on par with the going rate of 5%.
Right. Okay. Now we'll flash back to 2008. Why banks failed in '08? Banks failed in 2008 because they lent money to virtually anyone who wanted a loan without sufficiently questioning whether they were going to pay it back on time. To complicate matters even further, banks marketed their faulty loans as safe investments and sold them off to investment banks and other kinds of financial institutions in complex packages. This was the whole thing with the credit reporting agencies were making them all AAA, and then there were all the credit default swaps where people were basically investing on the bet that these wouldn't fail, and there were layers of those credit default swaps they all ended up being worthless.
Mm-hmm.
Okay? All right. Not happening today.
No, that's not the case.
Not the case. Remember, back then, only 16% of homes were free and clear. About 70% of all homes were upside down back then.
Mm-hmm.
70% of people in homes back then were upside down.
So upside down means that you owe more for your home than it's worth. So let's say that your home is worth $500,000 and you owe $600,000. That's a problem.
Okay. Why banks failed recently? The 3 banks that failed recently didn't properly manage interest rate risk. They all had invested in long-term treasuries, which tends to be a safe move, but the Fed hiked interest rates, the value of these investments fell. When the banks experienced bank runs, they were forced to sell the investments at a loss, leaving them without adequate cash to back borrowed funds. Bank run, period, end of story. It was a panic. These banks would be around. The first was Silicon Valley Bank. Silicon Valley Bank, the story is that some VCs, David Sachs and a couple other ones, got wind that they were having these problems. So they went and said, hey, look, I'm going to pull all my money out. And they went to everybody in their fund and all the startups they invested in and said, get all your money out. And then people started sharing this information. Hey, this bank may go out of business. Get your money out. They all got their money out. And there was just a run on the bank.
Right.
Because remember, the banks, your money isn't physically sitting in the vault at the bank. Your money is in these investments that are predominantly illiquid. And if you want your money back out, they have to sell those investments. Mm-hmm. So if they've invested $1 million at a 1% security, and then you come and say, hey, I want to get my money out, and they have to sell that $1 million thing, well, they bought it for $1 million, but they can't sell it for $1 million. So now they're going to sell it for $700,000 because they need to pay you. And you can see where this ends up going. Right. So yeah.
If you want to see what a bank run looks like, watch Mary Poppins. There's a scene about a bank run in there.
And It's a Wonderful Life.
Yes.
Actually, prior to the Federal Reserve, there were numerous financial panics throughout history. Thousands of financial panics where banks just went out of business because there were runs on the bank. Right. Okay. Their poor investment choices, unlike 2008, aren't bringing down the entire banking system in part because there aren't as many secondary markets tied up. Mm-hmm. Right?
Right.
Okay. The banks that failed recently did not even have issues with their underlying loans, meaning these loans were valid loans, unlike the previous loans, which were these real estate assets that weren't worth what the paper was worth.
Right.
You have a note for $350,000, but the house only worth $280 because they gave the people the money plus extra cash to fix up the house, which they never did. Okay, that is a big difference from 2008. The problem is the interest rate risk and the liquidity of the banks. Mm-hmm. The loans are the notes are still valid. They're just low interest rate, so they're not very profitable in a 5% environment. Mm-hmm. Okay, all right. Now I'm going to show this one chart because I found this. I was trying to find a chart that kind of demonstrated how much equity people had back then during the crash versus now.
Go ahead.
This is a Fred chart. This shows the equity as a percentage of household real estate. If you look down there where you see the line is really low, that's the housing crash, okay? People then only had about 45% equity in their home. Mm-hmm. Actually, the number today is 71%. This number is accurate as of September 8th, so it's about a month old. 71%. So here's what this means. Let's say that you have a house worth $300,000, that you only owe 29%, that's 71% of its equity. Now, this is the whole housing market for the whole U.S. Now, remember, some people are free and clear, 42%. Some people have very small amounts, but most people have an in-between amount, right? But you can see that these in-betweens net up to being, they own 70%, which is different from back when people had very low percentage. Matter of fact, when the housing crash started, you can see there, if you go back to 2006, it was under 60%. It's the lowest it has ever been. The lowest amount of owner's equity ever with a lot of loans is what crashed housing. That's literally what crashed housing. What set it off were these subprime loans that people were getting. But if you look today, we have the anti-housing crash. It's the opposite of what could crash housing. It's literally the reason why prices are going up with interest rates being what they are. This is the thing I think the crash bros don't understand. This is basic economics. The crash bros don't have economics degrees. They just make YouTube videos.
As opposed to us who have MBAs.
I have an MBA. And you have a degree. I have an undergrad too, but it's in it's a computer science degree. Okay, Juana. So I want to talk about one more thing. I've been talking a lot. You've just been sitting there looking fantastic.
Okay.
But here's the thing I want you to go through with the people. Because there's two theories. We'll start with the first one. But Todd, if the bank, when the banks all crash, because they're all coming, the banks are getting ready to all crash. When the banks go away, nobody will be able to get loans for the houses. There won't be any banks, and that will crash housing.
Short answer? Wrong. So first of all, banks don't just go away. They are acquired, because that's what happens, right? In the case of the biggest bank that went away, Washington Mutual, that was acquired. So banks are acquired. The first thing that happens when a bank goes away, as far as somebody who has a mortgage with that bank, is nothing. Because most of the time you make your mortgage payment to a servicer, not to the bank. And you keep on making your payment, because whether that bank exists or not, you still owe the debt. So whoever inherits that bank, whoever buys that bank, whoever takes over that bank, whatever that looks like, you still owe that money on that financial instrument. So there is still money, there's still liquidity in the system. The other thing to keep in mind is that your loan was packaged and it was sold, right? Because that's usually why I have a servicer, because you don't really have a loan with Bank of America or Wells Fargo or whomever. You usually have a loan with, that's who initiated your loan, that's who originated your loan, but your loan was sold off. And it was sold off to, the Atlanta, Georgia Teachers Association, or, some insurance company or whatever. Because that's what happens with mortgage-backed securities. They get packaged and they get sold off, because that's how financial institutions have money to lend. Remember that most mortgages are actually not even put out by banks. They're actually put out by mortgage brokers, who then again package these and sell them off in order to get money to make more loans. So that's the way the system kind of keeps going round and round. Part of the job of the Federal Reserve is to have liquidity in the marketplace so the economy can keep going. So all of this is kind of a long-winded way to say that there is money out there for loans regardless of the economic environment, because there just is. There's always money in the system that needs to be invested, and one of the ways that it's invested is in mortgage-backed securities.
The problem the problem was more so the credit default swaps than it was the actual underlying. Yeah, the banks lost money on the notes, but remember, a lot of those notes had already been sold to investment funds. Like Wanda said, the Athens, Georgia Teachers, retirement fund bought 1,000 houses around the country, the notes for 1,000 houses. And when you made those mortgage payments, that money didn't go to a bank, it went to their fund. The problem was the banks doing these credit default swaps, where they were basically investing in the security and then investments on top of the investments. Basically, they were gambling in this expanding tier way. It basically a house of cards, where a couple cards at the bottom is the housing market, and then all the cards above it are the credit default swaps. And when the housing market ended up not being financially stable from a financial point of view. It collapsed the banks that had put a bunch of money toward
Right.
credit default swaps. And that's what took out the banks.
So the other way to think of it is if you take out a loan and you die, does that mean that that extinguishes the loan? Well, of course not, right? I mean, the loan is still due. So it's the same thing with the banks. If the banks die, it doesn't mean that you have their house free and clear or that you no longer owe the money. You know, you still owe the money and it just gets paid to the next beneficiary of that bank. Same thing with you. If you die, then the beneficiary of your estate has to pay the loan. It's the same kind of thing.
Do you know who the largest giver of home loans in the country is?
Tell us.
United Wholesale Mortgage, UWM.
Mm-hmm.
They're larger than anybody. They're a mortgage company.
Mm-hmm.
Rocket Mortgage.
Mm-hmm.
They used to be, I think they were Lending Tree.
Mm-hmm.
Banks, Wells Fargo doesn't even do loans anymore.
Right.
Because there's not enough money in it, the spread, what they make on the loan. Because remember, they don't keep the loans. They sell the loans in secondary market.
Right.
It's a lot of work for them to go, they have to have a bunch of people to originate the loans and do all this stuff. And remember, there aren't that many loans because there aren't that many houses being transacted.
Right. So Wells Fargo found that it wasn't just Wells Fargo. A lot of brick and mortar banks found that they could not compete with the online mortgage brokers like Rocket Mortgage.
Yeah.
And that's why they got out of the mortgage business.
Right. Okay. There is zero evidence. First of all, there's zero evidence that banks are going to collapse.
Correct.
Even though a couple did, that was a shock from the 3 or 4 month rapid rise in interest rates.
Mm-hmm.
Okay. That's the first thing. There's no evidence going forward that there's significant problems. There's 1 or 2 banks, I think, right now that are probably pretty close. But there's not like a chain of events that's going to cost 425 banks, which is what happened last time. Also, those banks did not negatively affect real estate. It was the other way around. It was credit default swaps. Mm-hmm. There's nothing today showing that anything happening with banks is going to do anything with housing. Nothing at all. Not when 70% of all real estate assets are equity and only 30% are loans. Mm-hmm. With the highest number of equity we've ever had in real estate. Right. And what are the percentage that 30%? It's 2 things, Juana. It's at the highest percentage ever, and then that 30% that's financed is financed at the lowest rates ever. Mm-hmm. Because remember, it's a problem for people today buying, but it's not a problem for everybody else that already has a house.
Correct.
Everybody else that has a house is fine. Mm-hmm. And I understand the people that don't have a house that are upset. But here's the thing. This is a self-fulfilling prophecy, and this is why. One, if you can't afford to buy, what do you have to do?
Rent.
So if you have all these people that can't afford to buy, we're creating more renters, right?
Correct.
So if we're creating more renters, and how does that work with supply and demand and rent prices? If we're just adding people to the rental pool without adding more rental houses?
Rents go up.
Rents have been going up. We've shown a chart on another video where if you saw the chart of rents going up for the last 40 years, you would probably have decided you should have only ever bought real estate and just rented it out because the ROI ends up being crazy. Mm-hmm. So anyway, any final thoughts before we? Because I think we just proved the point that there's zero correlation between banking and housing right now.
Right. So look, the bottom line is, for the most part, the banking system is really sound. Real estate is not going to crash banking this time around, and real estate did not crash banking the last time around.
No, real estate crashed banking.
I'm sorry, yeah.
But banking didn't crash real estate.
Yes. So real estate is not crashing banking this time around. Banking is not crashing real estate. Last time around, yes, real estate crashed banking, but it took years. I mean, it didn't happen instantly either. I think there were a lot of lessons learned, and I think banks are in a better financial situation to deal with this. I think the 3 banks that did experience a traumatic event this year, I'll put it that way, I think those were a wake-up call for the Fed, and I think the Fed is watching banks much more closely and helping them have better reserves so that banking remains stable. It's an important part of our economy, And so I don't see that. I don't see a cataclysmic banking event the way we experienced before. I think we're in a different situation. And for those people who say, well, no, it's not different, it's the same thing, you know what? I'm not going to argue against it without data. So show me the data, because the data that we're looking at doesn't support that. So if you have something different to say, please, by all means, leave us comments, and we'd be happy to have a discussion with you. Remember to leave us comments about real estate related matters. We enjoy your comments. Please like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.